for the first time. I know that there are quite a few new councillors here, but we also have an awful lot of experience in the room. You Roberto. How many years have you been on the committee? How many years have you been on the committee?
79. It was a privilege initially because the fund was operating rather like a cabal. The chairman used to take members of the fund to Larkbeer and give them a 3-course lunch plus wine out of the fund. That's how it started. And in due course, the chairman's lost all those privileges, and now we, if we're lucky, we're offered sandwiches. But having had the length of experience, I can tell you that it's fascinating to see how well this fund has operated over this very long period. Your officers have been brilliant. There has always been a push from central government to get hold of our funds in one way or another. And if they fail to do that, they've tried to actually get us to invest in particular ways. The game isn't finished. So I look forward to seeing how this committee handles some of those issues. Thank you for asking.
Thank you, Roberto. We need a new slot. We'll get a new slot, the Roberto slot, on the agenda, and I'll see what I can do about red wine and nibbles as well. So item 1, chair's announcements. Because we've got a mix of councillors and non-councillors, I think it's fair that we all use first name terms when we refer to each other. So that's my intention. I'll remind people that this is being live streamed, so when you speak, please do use the microphone. We have a number of attendees who are online, and just to remind you that because you're online, you will not be able to vote on the items where a vote is necessary. A couple of other things I'd just like to mention, that when the minutes, the pack was sent out, the minutes for December's meeting were included and not March's. I know that Fred has sent those minutes out, so I'm going to assume that everybody has seen those and read them. I also want to point out that the March webcast is missing. The intention was for that to be uploaded onto the Devon County Council website. That didn't happen, and that recording is also missing. So as an item for Fred, I'd just like you to review process and report back to me next week, if you could, on how we deal with that in the future. Final item from me, to ensure that we've got everybody here in this meeting, I'm proposing that we move part 2 of the meeting forward to before item 4 on the agenda. I will mention that again in a moment because we'll need to put that to the room. In fact, perhaps you could advise, Angie, Mark, would I need to do that now?
Fred will advise.
Fred.
Yes, so it's at your discretion, Chair, to move items kind of earlier or as appropriate. So at the point it would require an additional item. So obviously we have exclusion of the press and public, and then the part 2 item. We'd need to then add another item kind of live to bring the press and public back in. But yeah, you can do that. So as and when you're ready, the room can vote to exclude the press and public. The live stream will pause. We have an observer who'll need to leave the room, and then
Okay, that's good. That's fine. So we'll progress with items 2 and 3, and then we shall do that. So item 2, apologies for absence, Fred.
So I have one from Councillor Mark Lowry, who's the Plymouth district representative, but Sarah Allen, who's the name substitute, is online in his place.
Okay, that's great. Thank you. Moving to item 3, declarations of interest. Does anybody have a declaration of interest in any item to be considered at this meeting? That appears to be no.
And just for clarity, if anything does come up in the meeting, you can declare it during the item as well, if anything that you've missed.
Okay, so I'm going to propose that we have a new item added to the agenda now to pull part 2 of this meeting forward. And we need to go to the room for you to approve of that. All those in favour? Okay, so let's do that. So we need to cease the.
Yeah, so Will, are you okay to pause the live stream and then confirm when that's done?
Okay, welcome back, everyone. We're resuming the open committee from earlier, moving straight on to item 4, the minutes from committee meeting in March. Any questions or comments about that? In which case, let's move. Suppose that's a true and true state. Okay, so that's Jeff and Henry. All in favour? Okay, that's item 5, items requiring urgent attention. I'm not aware of any items requiring urgent attention, so we shall move to item 6, Devon Pension Board. What I will do is I'll just read through the page numbers. If anybody has a comment or question as we're going through, then please, So Devon Pension Board minutes, page 11, page 12, page 13, page 14, page 15, page 16.
Just to say, Chair, that if there are any specific recommendations that come through that aren't covered in other items on the agenda, then we would highlight them to you. But I think most things that are on there come up on the agenda or were just discussions that didn't need particularly to bring anything to this committee.
Okay, thanks, Mark. So that is noted. Moving on to item 7, Brunel Oversight Board. And the minutes of their meeting held on the 3rd of April.
Page 19.
Yeah.
Page 19. There's an update under item 5 about the representations and the consultation response. We've actually covered that already, but I'm wondering if there's anything else that's emerged that's relevant from Brunel.
Well, I don't. I mean, this meeting was before we got the letter, so a lot has changed since then. I mean, obviously Brunel are working through this along with the partner funds. I mean, one thing that I didn't mention earlier that might be an issue is obviously it creates a deal of uncertainty, and that's something that's a bit of an issue for staff at Brunel and so on going forward. So just something that we need to be aware of.
If we're happy, that's noted, Fred. Item 8, governance policy and compliance statements. Hear from Mark on this.
Hopefully this is just procedural, but it just to update the policy to factor in the decision that was made by full council that the committee should have 7 county councillors rather than 6 because of the proportionality rules, that 6 didn't really work in terms of getting the right numbers and right political balance. So there's an increase of 1 on the committee. So it's just to update the policy to reflect that, just changing 1 number in the policy essentially. We will have to undertake a full review of the governance policy and requirement statement once the pensions bill and accompanying regulations have gone through, because there will be a number of governance requirements that the government are putting forward, which were in the Future Fit consultation. But so it's just a question of updating the number of county councillors on this committee from 6 to 7.
And Mike, you have a comment?
You said in your introduction to us all earlier this morning that we represent a number of district councils, and their pension funds are by Devon. Why is it they only get 1 representative?
It's general convention that the administering authority should have the majority of seats on the committee. So hence that's the way it's set up. So there are 7 members of the administering authority and 6, and there are 5 other reps on the committee. So and that's what was established a while ago. So there's 1 rep from Plymouth, 1 from Torbay, 1 from district councils collectively. We are still awaiting them to appoint a new person, because it was previously Phil Bielek from Exeter who has decided to step down from that role. There is 1 rep from the smaller employers, which was Ray Bloxham, who was there in his capacity as a member of Cranbrook Town Council, but he's now stepped down from that role, so we're also seeking a replacement for him. And then Roberto is here as a fund member representative, so that's 7 and 5 from other places. So make sure that we keep a majority of county councillors on the committee. And we have two union observers as well as Roberto representing fund members.
Okay, we've got a query from Michael online.
Hi, thanks, Chair. I'd just like to raise concerns and what I see as a kind of perverse situation, funny enough, in what's just raised about the union representatives. As shown in the diagram, that's split over those who are currently beneficiaries of the fund, which are people like Roberto, and contributors like myself who are paying into it. And due to the fact that there is only 1 vote between all of us, essentially we have, in my mind, a bit of a perverse situation where the only people who don't have a vote on this body are the people actually paying into the fund. Meanwhile, everyone who sits on the committee who doesn't pay into the fund do get votes. I do think that's kind of bizarre situation to be in, because even though you are assuming that we're all just, because we're in the same union, we therefore have the same view, I think there are differing viewpoints between those who may still be contributing, like myself, who has approximately 39 years still to pay into this fund, and someone like Roberto who is now benefiting from it and is then more concerned about the day-to-day payout of funds. So I would like to ask for justification of that and whether it can be changed. Thank you.
Well, I think that's a debate that could be had. I mean, it had been the case for many years where the union reps didn't get a vote at all, and we changed the rules a couple of years ago so that you got 1 vote. I think we'd need to talk to our Democratic Services colleagues about that, but we can consider that as a future.
Yeah, I think if there's
as part of a future review, I suggest.
if the committee did want to add that as a resolution, it's just that it's kind of brought away and looked at that. Yeah, that will happen before. I don't know the historic process for that, but do that.
Yeah, so it is for, yeah, it's for you to decide between you who gets the vote. So I think Roberto's currently got the vote, but it doesn't necessarily need to be so under the terms of the policy. It's up to the unions to decide which one of you gets to vote. But happy to bring that back if perhaps we can consider that when we consider the governance changes that are going to come out of the pensions bill.
Yeah, that's fine. So I mean, we can have that as a recommendation that it's just considered and had as part of a future meeting at the appropriate time, perhaps, as Mark says, that's considered.
Okay, yeah, so that can go through as a recommendation. In terms of what we are moving on today, it is the changes that are in item 8. Are there any additional comments? Can I get somebody to move to approve the revised governance policy and compliance statement? Henry, second there. Those in favour?
Add in recommendation about coming.
So generally, the cleanest way is kind of everything that's agreed is going to be moved is then moved all at once and seconded by kind of 2 people. So it will just be listed as an A and B, and then they're voted on together. I mean, and then, well, once that's moved or seconded, if anyone opposes it, they can then propose an amendment. If anyone wants to cover that. That makes sense. So
It does make sense, Mike.
Clarification, does the pending legislation, is that likely to only impact governance arrangements, pension funds? Or are you effectively saying until we've got the new legislation in place, it's best to leave any review of our internal governance arrangement voting until we know what the framework of the new legislation is?
So I'm effectively asking you just to confirm that the policy needs to change because it has to change because of the decision of council. We will need to review the governance arrangements. There's a whole raft of changes that are being proposed as part of the Fit for the Future consultation that will then come out in regulation that follows the pensions bill. So we will need to consider it at that time. That will include issues around knowledge and skills requirements of members of the committee, for example, how we arrange ourselves as officers. There are going to be things in there about that the government want us to have a review of our governance arrangements externally every 3 years, a bit like Ofsted for pension funds, you might say. So there's a whole raft of things that are potentially coming out in regulations that will follow the pension bill that we will need to incorporate into our governance policy.
But in terms of that resolution, can you give me some wording?
yeah, so number A will be as laid out there, although it might be worth for clarity. I might add that specifically refers to the change to reflect the political balance. And then B, that officers, I haven't got the full wording, but that officers explore the, Mark, help me out.
And that union voting rights should be considered as in response to the changes in governance regulations.
Officers explore union
from government.
So so something along the lines of officers explore union member voting arrangements alongside the review that will take place in response to the future consultation or something like that. So basically explicitly say that will be considered alongside consideration.
Okay, in terms of what Fred has just said, can I have some?
I will obviously tidy that up in
Somebody's happy to propose that?
Yeah, I'll propose it again.
Henry and Mike has seconded it again. Okay, and those in favour? It's everybody. Good. Moving on to item 9, annual internal audit report, and we have Alexis reporting in place of Hannah.
Right. Yeah, thanks, Chair. Yes, so this is the year-end report for internal audit. Devon Insurance Partnership provides the internal audit function for Devon Pension Fund and Peninsula Pensions. Obviously, this was the audits that were completed during the 24-25, and the committee are asked to note the internal end-of-year report for 24-25. I'd like to draw your attention to page 30, which details the coverage of the work undertaken in 24-25, along with the level of assurance provided for each review. As you can see, all bar one have received either substantial reasonable assurance, and in relation to the data quality review, which had limited assurance, we've got some follow-up work planned in for 25-26. And page 31 details our overall assurance opinion for the year. As noted in paragraph 4, we have provided reasonable assurance overall. And page 32 onwards provides a summary of our findings from the audit work undertaken for each of the reviews. And that's probably what I need to say, unless anyone has any questions.
Yes, Mike.
Just one point. It relates to the table on page 5, where you've got the good governance review, which is now replaced by the local impact portfolio. When you go to the local impact portfolio, which is a brilliant idea, and we could put more funds into it to impact, it's about investing effectively in your local, using the investments in your geographical area to boost economic growth in your own area, which is excellent, first good. But I can't see how that is now, how that would have related to good governance review. I've seen that being something entirely different than a local investment policy. So just wondering how we've got to a situation where governments has been replaced by an investment portfolio about locality. If you could explain.
Yeah, so when we set the plans at the beginning of each year, which the plans for 25-26 have been set in place now, they are flexible, they're agile, so things will change as priorities change. And the good governance review was, it kept getting put back because there was a consultation and it was supposed to be coming in under the previous government, and it kept getting deferred and deferred and deferred. So as a result, the audit that was sat with that got deferred and deferred. So because we have a set number of days to deliver for the internal audit, we have sort of backup our sort of contingency audits in place that we pick up where we have to drop an audit. So that's what's happened in that instance.
I think I now fully understand. It's the wording, I think the way you've put it there. The implication is we no longer have good governments. We've now got this local thing, and the two are combined. What effectively you mean is you have deferred looking at good governments and instead replace that by looking at the local impact portfolio. Sorry, that was partly my misunderstanding, but I think that could be construed from the way the report is laid out. So sorry.
Roberta, you've got a question.
On the appendix A, you are indicating limited assurance for data quality from the employers. Can you explain how you can improve that? Because you show a figure, roughly 60% compliance with what they should be doing.
Well, we obviously, this particular piece of work was particularly around the information that the employers provide through the employer interface, and the outcome we had 60% was fine, and the other 40% weren't for different reasons. As far as improvements are concerned, the Peninsula Pensions are already doing things with the employers to help improve that information. They're looking to clarify what we've the work that we've done to make sure that the information is either actually they didn't provide us with the right information, or that there is issues with their data. And our role is then we'll go back then later in the year and actually have a look at what they're doing internally to help improve that information that's coming in from employers. But we're also doing some further work with more employers. We're going to be extending our sampling, looking at a wider range of employers during the year to see whether we've picked a bad sample or whether there is a bigger problem.
If I could just add to that, and Rachel could probably give more detail, but I mean, we are reliant on the employers being able to provide the correct data to us in terms of being able to pay people the right pensions. So the aim of this was to say, well, is the data that's coming from employers correct? And in the majority of cases it is, but there were a number of cases where when the audit partnership insurance partnership went back to and got data to compare from the employers, it didn't match, and so that raises an issue. Now the team will go back to those employers and try and doubly make sure that that information is correct, so we will sort it. But the implication is that this is a sample, and if we found errors within a sample, then how much that then indicates that there are going to be other problems with other employers. And so what we're going to get Devon Assurance Partnership to do is to do some more sampling, more work on a different sample, so that we can see whether this sample was not representative of employers in general, or to determine whether there are more issues out there that need to be looked at. And that's the follow-up work they will do this year.
Simon.
Thank you. So, am I right in understanding that just as that these employers where things don't match up, so it's not in our gift to fix that directly, because we are not amongst those employers. So that leads us on to the question: is what are the potential? I mean, does their, in inverted commas, bad behaviour, is it likely to have a direct impact on Devon County as an employer member of this fund in any way?
But it could have implications for individuals getting the right pension, which is obviously something that we need to be assured of.
Individuals who are beneficiaries as former employees of Devon, or individuals who are from the wider fund?
Rachel can provide the detail, but I probably don't want to name the employers involved. So as I said in the induction section at the beginning, we administer pensions on behalf of a wide range of employers, not just Devon County Council. So I think Rachel can confirm whether this sample included Devon County Council. No, it didn't. So it's not Devon County Council, it is other employers that are the concern.
Hello everybody, I'm Rachel. Not met all of you, so I'll just quickly say that. I head up the pension admin team for the shared service. So just to add, the team, what we're doing is the employers involved have already been contacted. They were contacted straight away, and we are meeting with them to re-educate, I think it's probably the word, provide all the training materials that we have around, and the guidance for getting the information correct, because obviously it is key to the subsequent pension that the individuals receive. And we're also working with Devon's internal communications to see if we can get some mandatory training for employers, so that we do like a quarterly mandatory quick training on different aspects which are highlighted by the audit, just to try and do all we can to improve that going forward to start with them.
Thanks, Rachel.
Can I just add to that as well? You're saying our sample, I think our sample was 18, I think, of the employers. I think it was 18. 18? It was 18, yes. And it was all of the employers that submit through using the employer interface template, because there are other employers that don't use that method at the moment, so they happen to be included in the sample. So yeah, just to give you a little bit of context about the sort of the numbers there, really.
Okay, thank you. Any further questions? Okay, so that report is noted. Thank you. Moving on to item 10, investment management report, where the committee is being asked to note the investment management report and compliance with the 2024-25 Treasury Management Strategy. Mark.
So So this is basically an update on where we are at with our investments and their performance and so on. So it's one that we bring to every meeting of the committee. So the table that you've got on pages 39 to 40 of the report shows the current value of the funds split between different asset classes, with the allocation to each asset class compared to the target allocation. And hopefully you can see that for the most part, they are broadly in line with the target that we've set. At 31st of March, the fund value stood at 6.13 billion, which was actually a fall over the quarter because of investors being concerned about Mr. Trump's tariffs. But nevertheless, we had a positive return over the year of plus 3.7%. So again, looking at that table, the underweight allocations are all within the alternatives area, which relates to private markets investments. We've made commitments to each of those areas, but those commitments haven't all been drawn by the funds that we've committed them to. Once they are drawn, that would bring all of those up to target. But as I explained earlier, that takes some time to achieve. Also, just to note that the percentage allocations in that table were the percentage allocations for 25-26. Since the end of March, we've made some changes to those allocations that were agreed by the March committee. So, for example, we've allocated 5% of the fund to index-linked gilts for 26-27 and going forward. So when you see those percentage allocations at the next meeting of the committee, they will be different, and indeed they're different in the report that is the next report on the agenda. The graph at the bottom of page 41 shows investment performance over the last quarter, year, 3 and 5 years compared to the fund benchmark and the LGPS average. So the fund benchmark is a weighted average of the benchmarks for each of the individual asset classes. So for example, the global high alpha equities allocation is benchmarked against the return of the MSCI World Index. And while the fund's investment performance is below benchmark over each of these periods, it is ahead of the LGPS average. And the biggest underperformance against benchmark was on the global high alpha and sustainable equity portfolios, which have not, the active management of those funds has not delivered returns as good as the index returns. You've got some more graphs on page 44, which look at the impact of exchange rates on our investments. So given that we have significant global investments, if the value of the US dollar in particular reduces against the pound, then the value of our US dollar denominated investments will go down. So therefore, we've got a currency hedging strategy in place that is designed to mitigate those risks. And the second graph on that page shows that over the last 3 years, the strategy has added value to the fund. If anybody's got any questions at that stage, and then I'll carry on to the rest of it.
One brief one. In relation to the chart on 41, which also relates to the chart you showed us earlier, where you're showing benchmarking. Do you include how market funds generally have appreciated the year as a benchmark for you to use against? Because at the moment it appears you're benchmarking against your own peers. In effect, you're looking at how we've done against other local authority pension funds.
Yes.
And I just wonder if there's anywhere for our background to know how the market funds managed by the market, not for local authorities, but generally, whether they are shown there, because we don't know whether you're overperforming or dramatically underperforming against the market as a whole. And I just wondered whether those figures are available, whether it could be added as a line for comparatives.
Can I bring in Anthony?
Thank you, Chair. You're straight into a very, very difficult area of understanding, unfortunately. And part of it with the pension industry in the UK is the LGPS is by far the largest investment pool for which has an open pension scheme arrangement. The monies which are managed for corporate schemes are almost complete. I think there might be 1 or 2 which aren't closed to new members. So the asset allocation for those funds is predominantly invested in in government bonds. So it's very difficult to have a comparison to how that money is managed to how our money is managed. So the most reasonable way in which we can do the horse race, if you like, is to look at the LGPS universe, which is the green bar in that chart on page 41. It's not all of the LGPS because not all of them present all of their data to PIRC, who collect this analysis, but I think it's about 2/3.
Yeah.
So it's not an unreasonable estimate. So that's the peer group, if you like. But the other way to think about it is, if you wanted to look in more detail, would be to look at the line items in the table, where you can see, for instance, the high alpha equity fund. I'll look at it rather than guess it. But if you look at the under equities, the second line down, global high alpha equity, over the financial year, that fund delivered plus 0.8%, and the benchmark, which is the FTSE All World Index, delivered 5.2. So that's especially poor in that particular period. But if you go over to the more meaningful period, over 3 years, you can still see it's underperformed 6.9 versus 8.8. But it's that you have to look at those longer periods to see whether you're meaningfully underperforming benchmark. So that's if, you do need to take into consideration this detail as well.
Trying to ascertain, I would assume a pension fund might be conservative on its investment policy on the general qualifying unit shares or something like that, but you work for and invest £1 million less conservative in the investment situation than, say, a pension fund.
Sorry, I didn't quite catch that.
What I was trying to assume is how as a pension fund or a local authority do we go in relation to other funds that are set up rather than individual equities, other funds that I might put into as a common investor or a company, or etc. How are we doing it against the general funds in markets? So, in other words, I would tend to think that we as a pension fund are more conservative in our investment policy, less adventurous than more general funds. But I just wonder if there was any way of us knowing what their returns were and how, to what degree we were
if I could
keep it in line with the market.
If I could just if you're looking at the whole fund performance, as Anthony says, I think that's quite a difficult thing to gauge. What I think Anthony was trying to say was that if you compare us with a private sector defined benefit scheme, and there's not that many of those left, we would take more risk than they would. We would have more in equities, less in bonds. They would have much more in bonds. Therefore, we should be generating a higher return than they are. But it's difficult to compare. And part of that is because their pension liabilities would have to be on the balance sheet. And whereas for local government, because we've got a long-term sustainable position, and we are investing, as I said earlier, we're investing money now for somebody to receive a pension in 60, 70, 80 years time. We can have a longer term view, and if the assets go up and down a bit, it doesn't matter that much as long as they're going up in the longer term. Whereas a private sector pension fund, they have to be managing that volatility much more than we do, and they will have a less jagged line, but it won't go up as much over the longer term. So from that point of view, it's quite difficult at a whole fund level to compare ourselves with other pension funds or sovereign wealth funds or anything like that, because our aims and objectives are slightly different.
If I might also add, what it comes down to is you should never take more risk than you need to. And, for for a pension fund investment. So what we need to do is understand the amount of risk we're taking, and that will be informed by what the actuary tells us every 3 years at the triennial valuation. And they will give us what they refer to as a discount rate, which is the rate at which they've discounted the liabilities in order to be able to pay all of the pensions, based on a speed camera photograph, if you like, on the 31st of March 2025. And what we should be trying to do is achieve a return which is in excess of that rate, to give ourselves some cushion to be able to deliver in bad years as well as in good years. And that, if you like, is the objective of the fund. If you're just the general funds which you refer to, it comes down to risk appetite. And if you've been to see an IFA, or if you've been to we're all bombarded now by Best Invest, Fisher, II, etc., telling us all this sort of stuff. And you go on their website and they'll give you all these fantastic funds which they think are doing really, really great job. They won't tell you anything about the risk you're taking. They were always talking about the return, but we've got other things which we need to take into consideration. So it's probably not a fair comparison to look at those either. And as Mark was saying, if you're a sovereign wealth fund, you've got a completely different set of parameters which you need to be trying to match. But it comes back to that for a pension fund, you take the amount of risk that you need to take to deliver that long-term objective.
Okay, Simon.
On which point? Thank you, Chair. So when I was cutting my teeth in this area, we used to look at something like a Sharpe ratio, risk-adjusted return. And I'm a bit neuralgic about just looking at returns on their own. I think that, it's like looking at the goals scored column at the Premiership. That if you've got a leaky defence, then you're only seeing half the picture. And it's sort of, you have to dig quite deeply into these papers before you find any measure of risk. I'm just wondering if we can bring that slightly more into the foreground.
We can certainly look at that. I mean, you have, within the papers that get sent out, you have the Brunel quarterly report, which has a lot more detail on each of the individual portfolios, which I'm pretty sure has risk metrics within it. So you can get a feel with that. I mean, generally, at the conclusion of the formal business of this, we then have a session with Brunel where we go through their reports and hold them to account on investments. And just going back to the previous point, for each of their individual portfolios, and it's difficult to do comparisons at fund level, but for each individual portfolios, they do some sort of peer group analysis, as well as looking at the benchmark, which does comprise not just LGPS funds, but other funds that are invested in comparable portfolios. But that's about getting the correct peer group right, but that's on an individual portfolio basis. We talked a lot about risk when we looked at the strategic review. If you go back to the papers for the last meeting of the committee and look at the strategic review, there will be stuff about risk in there as well. But we can look at see if there is anything more that we can add into this.
Thank you, that would be helpful.
Yes, Anthony.
All of that stuff, it's under the bonnet. What you're looking at here is the whole car, if you like, but all of the information that you're asking is available. We get support from Reddington on the strategic asset allocation, and there's lots of reports within the Brunel environment which will give you Sharpe ratios, information ratios, will tell you what the ex-post tracking error is, what the ex-ante tracking error is, and various other measures of risk, and peer group analysis as well. So there's a lot more information if you would like to see it, but careful what you wish for, if you don't mind me saying.
It's a balance between giving you what you need and not overwhelming you with more than you can cope with.
For sure. I mean, I think that some, and I don't want to get down into the weeds, but I think it is always important when considering, and just having on the face of the report, just having the returns without any indication of whether we've been, you know, in a casino or in a deposit account, would be important.
Okay, thank you. I'm aware that Mark was just getting going with item 10, so would you like to carry on?
Yeah, well, I thought, because it's quite a long report and it deals with lots of different things, it's probably better to pause at that point. We were talking earlier about the actuarial valuation. So there's a report on funding, a section on funding level, that actually does provide us with an update every quarter as to their estimated fund level. But those estimated funding levels are based on rolling forward all the pensions data and just seeing what the impact of investment returns, etc., is on that. Because they're doing the full works on the position as at 31st of March, they haven't given us an estimate at 31st of March because they'll be doing the full works and giving us a much more considered and thorough analysis of that. But at the 31st of December, they had estimated a funding level of 101.3%. So we're actually in a small surplus position based on their analysis in terms of the assets of the fund compared to our liabilities to pay pensions. And that's the first time since I've been involved with the fund that we've ever been in that position. But hopefully that will then be borne out in the actuarial valuation. As I said, there will be more training on that at our training session in July. One thing just to bear in mind is that as well as looking at the whole fund, each employer will have their own sort of individual position, which will have their own individual funding level, which then goes to determine their contribution rates. And while if the funding position of the fund is at 100%, then there will be employers who have a funding position within that of more than 100% and others that will have funding positions of less than 100%. We've then got a report on the budget position. So we budget for investment income, management costs. During the year, we don't put a budget in for our investment return because that is very subjective to where markets are going. But the main budget, the variances against budget are shown in that report. In the main, the variances were positive for the fund with a small surplus of contributions during the year over the benefits paid out, which expected to have been the reverse of that. And we had higher investment income than budgeted and overall management costs below budget. So that's a positive. There's a section on cash management over the quarter. So we have been holding a higher level of cash than we would normally do pending drawdown of private market commitments. And we took a deliberate decision to do that because interest rates have been at a reasonably high level. So that's a fairly safe place to keep the cash that we had waiting to be invested. But if rates continue the downward trend that we've seen, then we will need to consider reducing the level of cash we maintain. And then the final section of the report details voting and engagement activity over the last quarter. So that shows in summary the votes that Brunel and Legal & General on the passive portfolios have cast over the last quarter and details of the engagement conducted on behalf of the fund. So we do take responsibility, we do take seriously our responsibility as owners of the assets we're invested in, and both Brunel and the Local Authority Pension Fund Forum conduct significant engagement with the companies we're invested in to ensure that companies are well managed and dealing effectively with the issues posed by such issues as climate change and human rights issues in the area of company operations and supply chains, etc. Again, happy to answer any questions on that bit of the report.
Yes, Roberto.
I think the report is very thorough, and I also think that there are two items I'd like to draw attention. We've all read it carefully. On page 43 are the dodgy bits, whereby we've got problems probably materializing in the short term and in the longer term in the whole world markets, mainly to do with the unsettling situation And the second item I'd like to draw attention to is the thorough way in which both the investments on the index and the companies that have been contacted by LATF have been thoroughly documented in the report, which gives us, although it's disappointing to see that some companies are insisting, like BP and Shell, on sort of diversifying back into oil, that we've got at least a handle in those shares. So as far as I'd like to do is to commend these particular, and to make sure that in future we continue to put pressure on the people we invest in.
Just to say on the LATF report that they are engaging on behalf of quite a large proportion of the LGPS funds across the UK, so that there will be information in there about their engagement with companies that we don't actually have any investment in, because other LGPS funds may do. So just bear that in mind. We don't necessarily have investments in every company that they engage with, although we probably do in the vast majority.
Simon.
Thank you, Chair. Just for my understanding, because we're all new, obviously not all newbies here, but some of us newbies here, the difference in funding levels of constituent members. So say my district council, I think came out of the last review with a small surplus. So in terms of its funding, is that solely due to the demographics of the pensioners?
It's partly due to demographics. So effectively, what the actuaries will do is they will measure the contributions that have been paid in by the individual employer. They will imply the investment returns that we have achieved as a fund to those contributions. Obviously, there'll be a brought forward number of assets that were allocated notionally to them at the last valuation. They'll add on contributions that have gone in, add on the investment returns, and then they will look at the data and they will assess what pensions are due to the employees past and present of each individual employer to determine what those liabilities are. Different employers may be in different positions purely due to the demographics. You generally find that if you've got an aging workforce, then you often have higher liabilities than if you've got a younger workforce. But that's not necessarily always the case. But it also may reflect decisions that have been made in the past. So there are some employers who have at points decided that they would like to pay more into the fund than we've asked them to. And if they do that, then obviously that goes some way towards reducing any deficit or creating a surplus. So it will depend on cash flows into and out of the fund, as well as the demographics.
Thank you. And if I may, Chair, just a question I should have asked earlier, which is when you were discussing the asset allocation, I mean, again, everybody does what they do, but I would be more used to seeing a range rather than a single target figure, especially particularly for the big chunks, global equities, et cetera, fixed income. So can I infer from that it's sort of built from the bottom up, or do we put a range in and then, or do we sort of say we think we should be X in equities and then go into the subcategories, or do we?
So I would say that the figure that you've got there is the center point of the range. We haven't particularly set different ranges for different asset classes, but generally speaking, if it goes 2% above or 2% below that target figure, then that's when we would look to take action. We have under decisions previously made by the committee, we have delegated authorities officers to move up to 50 million between asset classes, between committees, if we deem that we should do that. It is good practice to balance back towards the target if things go significantly out of kilter. Depending on circumstances, we might, if we want to move more than that, then it would be in this report to say, well, we think we need to take so much out of portfolio A and put it into portfolio B to bring it back towards target. And then we'd ask the committee to approve that or not.
Any further queries or questions? Okay, so that report is noted. Moving on to item 11, the investment strategy statement. As a committee, we're being asked to approve and adopt this. And again, hand over to Mark.
So at the previous meeting of the committee, and all, I appreciate that most of you weren't on the committee for the last meeting, so this has sort of been done to you rather than by you in a sense, but the committee did agree changes to the investment strategy following on a review that we had undertaken by Reddington. That review looked at the risk of the funds, taking your point, and suggested that while we need to continue to target a reasonable level of return, that we could reduce risk to some extent by making some changes to the strategy. So it was agreed by the committee in March that we should revise the asset allocation targets. That included agreeing that a 5% allocation to index-linked gilts should be established, which we hadn't had before, funded initially by a reduction in the passive equities allocation and the liquidation of an investment in Brunel's diversified returns fund portfolio. So those changes were agreed by the committee at its last meeting, and we implemented those changes in May and early June. So the committee had agreed that we take money out of equities and put it into index-linked gilts. We delayed doing that for a few weeks because of the state of the markets following on from President Trump's tariff announcements. The markets all came down significantly, and we didn't really want to sell out of equities at the bottom of the market. But when they then rebounded back up to pretty much the level they had been before, we then implemented that decision. So because we don't always, if we're buying and selling lots of assets, we don't really want to flag that up to the market in advance, because that might impact upon the price we can get for those markets. Although the committee agreed those changes, they didn't agree that the public investment strategy statement. So effectively what we're asking you to do is to approve the changes that were approved at the last meeting of the committee, were the actual statement that sets out those changes. In addition to the changes that we've implemented, the revised strategy also includes a reduced target for commercial property, but that does not need any action because we were already under target on that by the appropriate amount. There's also a new proposed allocation of 3% to a natural capital portfolio, which would invest in things like forestry and farmland. And part of that would, the intention of that would be to invest in a return generating asset, but at the same time, it's one that would absorb carbon rather than creating carbon emissions, and therefore is a positive thing in terms of reducing emissions. And also the agreement was that we should increase the allocation to the local impact portfolio, which we had created, from 3% of the fund to 5% of the fund, but those new allocations would be funded by a further reduction in passive equities. Those are not reflected in the asset allocation targets for the current year, but they are reflected in a medium-term strategy, and that's partly because we are reliant under where things are going on the pool to create those opportunities for us to invest in. And clearly with all the uncertainty and what's going on with pooling at the moment that we discussed earlier, that's not going to happen that quickly. So those things are in the medium term plan, and we should look to be doing them in the medium term, but it will take some time for that to happen. The other thing I just want to emphasise is that no changes have been made to sections 4, 5 and 6 of the investment strategy statement, which are related to the approach to pooling, stewardship and environmental, social and governance issues. We will need to review those sections in the light of the new regulations expected from government in the wake of the pension schemes bill. So we will come back to a future meeting on that bit of the investment strategy. In terms of the ESG issues, one thing that we are likely to be looking to do is that 3 years ago we did a survey of pension fund members on their views about different aspects of our investment strategy. We agreed that we would aim to do one of those every 3 years, so we should be doing that again. So again, we will bring a report to the next meeting of the committee asking for your approval to go ahead with that survey, and we'll bring you a draft survey for you to consider at that meeting. So at the moment, what we're asking is for you to improve the revisions to the investment strategy statement, which are primarily on the section on risk and the section on the different asset allocation targets.
Jeff.
Thanks very much, Chair. I'd just like to confirm that we did receive a presentation by Reddington, myself and Henry were there. It was debated fully. I think we had about half an hour. It was on it, yeah. And so I would recommend to everybody that we move this. Okay.
Yes, Mike.
Just a question, following on from my misreading the previous one, in regard to the local impact portfolio, which is now, I see from page 105, is managed by your own investment team in-house, in effect. Would it be possible at some future meeting to have a presentation at what we're investing in the Southwest and the impact it's making? It's allegedly an £80 million fund available.
We can certainly
members to actually find out what we're investing in locally.
We can certainly do that. I'll quickly summarise now. So we've committed £220 million to that portfolio. 60 million of that is to a fund which is designed to invest in renewable energy infrastructure across the Southwest. That is all. I think about 2/3 of that is currently invested in largely in solar sites across the Southwest, and then there's about 1/3 of that still to be allocated. There's another 40 million in another renewable energy infrastructure fund. With that fund, we agreed to invest 20 million into what is actually a UK-wide fund, but the other 20 million has to be specifically on projects in Devon, and they can't invest in a project in Devon unless it's also being funded from their UK fund as well, because then that gives us the assurance that it's a worthwhile investment from an investment return point of view, because they're doing it for other investors, not just us. Then we have two lots of 40 million in two different affordable housing funds, one of which is primarily shared ownership, the other of which is more social rented housing. And again, with both of those funds, there's the 40 million is half in Devon and half across the UK. And then the remaining 40 million is in a fund that is designed to support local businesses across the Southwest, and so it's basically providing capital for expansion of existing businesses or startup businesses that will then provide employment across the Southwest. They launched that fund in March, and our previous chair attended that launch event in Bristol. But they're also opening an office in Exeter as part of that fund, and there will be a sort of an event around that taking place in the near future. Which our chair and the chair of the council have both been invited to.
Thank you, and a very good test of memory.
Mike, does that adequately answer your question with no presentation required? I think that was pretty comprehensive.
I think that was elaborate, but at some stage, hopefully, it will come back on the agenda.
Yeah, we can go into more detail on that. Yeah, I can. We might try and incorporate that into one of the training sessions. That probably would work.
Okay, any further questions? I know that Jeff moved and Roberto seconded, but if we're happy with that. All in favour? Okay, it's approved. Moving on to item 12, climate change and carbon footprints, where we're looking to, as a committee, note the current position against the agreed targets in the fund's climate change policy. Mark.
Yes, so in 2021, the committee committed to have a net zero portfolio of investments by 2050, with a series of interim targets which are set out in paragraph 2.2 of the report. So that includes a 7% reduction per year in the weighted average carbon intensity of the fund's investments, with the intention of achieving, it's quite a big window, it appears, but a 50 to 75% reduction by 2030. Also aiming to have a target investment in renewable energy infrastructure, and aiming to engage with companies about their carbon emissions. So the report sets out the most recent analysis of the fund's carbon footprint and reserves exposure. So there has been an 11% reduction in the weighted average carbon intensity of the fund's equity and corporate bond investments over the year to 31st of December 2024. We do it on an annual basis, and that brings the reduction from the 2019 baseline to 68%. So there's a number of factors in that reduction since 2019. So Brunel adopted a very climate aware approach to investments in terms of managing climate risk. We have transferred our passive equity allocation to a Paris aligned benchmark. So if you look at the say the FTSE All Share Index, then that is purely based on weightings according to market capitalization, i.e. the value of the share price times the number of shares is the value of the company, and that sets its position in the index. The Paris aligned benchmark takes some climate data into account as well as that, in terms of deciding weightings of different companies in the index, with a view to achieving that 7% reduction per year. The global market over the last 2 or 3 years has been dominated by big technology companies, your Apples and Microsoft and so on. Those companies tend to have lower carbon emissions than your traditional manufacturing industries, and therefore the fact that they've gone up by more than everything else means that your average emissions has come down. But also we have seen companies that are managing down their emissions in response to where we're at. So that explains that 68% reduction, and clearly we want to keep that moving downwards. And it's not just about being ethically the right thing to do, it is also about managing risk going into the future in terms of the potential impact of climate change on our investments, and regulation related to climate change on our investments. So there's also a table or a graph showing exposure to companies with fossil fuel reserves. Back in 2019, about 9.3% of our equity portfolios were in companies that held fossil fuel reserves. Now that's down to about 0.2%. So we do still have, as it shows in the table, an investment with Shell, but we would have had a lot more in Shell going back to the past. Equally, we don't now currently have any exposure to BP or ExxonMobil or a number of other oil companies that we would have done through, particularly through passive indexes in the past. You can argue that both ways in terms of impact on climate change. Interestingly, company AGMs often have shareholder resolutions related to how the company is dealing with climate change. If you look at those, for a period, the number of people who actually supported resolutions calling on companies to do more about their carbon emissions was going up over time. If you look at companies like Shell and BP, that started to come down, and that's largely because people have divested their shares and sold them off to people who really don't care anymore. And so you could argue that by divesting, you've actually reduced pressure on those companies to actually modify the way they behave. But that's a debatable topic, shall we say. On the positive side, we are also increasing our investment in renewable energy infrastructure, both through the local impact allocations, as I said earlier, and through our wider private market allocations. Table on page 115 shows that we now have £332 million invested in various categories of renewables, which is just over 5%, which met the target that we set for us to have invested 5% of the total fund in renewable energy infrastructure by 2025. We could do more, we could do less, but clearly we have to set that within an overall investment strategy that achieves the financial returns that we're looking to achieve, and balancing the risks of that and ensuring that we have a well-diversified portfolio. There's a scenario analysis in section 7, which was done for us as part of the investment review, which demonstrates the potential impact on our investment returns over the future decades of 3 different climate scenarios, which demonstrates that there is a need for us to manage climate risk in the management of our portfolios, that we are not just doing this for ethical, environmental reasons, but we are doing it in order to manage real risk to our portfolios. Having said that, I mean, there could well be an argument that on a short-term basis, because oil companies' shares have been shooting up in recent years because of the situations in Ukraine and various other parts of the world, that our investment returns could have been slightly better if we had more invested in those types of companies. But we are long-term investors, and long-term investment is managing that ongoing risk of climate change is important.
Simon.
Thank you. I think it's notable that, you know, we've managed to make. Do you shorten it to WACC, or do you keep with weighted average carbon intensity? But that we've managed to reduce that so significantly over the course of the past 5 years, whilst, as we saw earlier, you know, whilst our returns have been more or less in line with both the benchmark and slightly ahead of our peers. So I think you mentioned, and I completely agree with you, the sort of the twin forces of the ethics of it, but also of risk reduction. There is, of course, not only, I mean, there's the financial risk of that future regulatory or sort of carbon market, etc., changes could have to happen suddenly, and that businesses that haven't taken big enough steps in the direction of decarbonising and so on will therefore be affected by that as well. So I presume that's one of the things that we're sort of addressing when we.
Yeah.
Thank you.
Any further comments?
One thing I should have said, I suppose, about the weighted average carbon intensity is yes, we want to bring that down, but it's not always you sometimes need to get underneath the numbers a bit as well, because you've like manufacturers of wind turbines generally have very high carbon emissions in terms of what they're doing, but they are nevertheless making a contribution to the future.
Okay, thank you. So that report's noted. Moving on to item 13, McLeod remedy implementation. We're going to be asked as a committee to approve an extension to that implementation date. Rachel.
Thank you, Chair. Okay, so one of our big challenges on the administration team have been what is called the McLeod remedy. So if I just give you a little brief overview so you know what you're approving, and then I'm happy to answer any questions. So in 2014, the local government pension scheme changed from a final salary scheme to a career average pension scheme. Pension based on service after the 1st of April 14 would be based on an individual's career average salary. Protections were put in place and provided to those that were nearing retirement age, but a legal challenge to changes to the judge's pension scheme, which the gentleman's name was McLeod, established that those protections amounted to age discrimination against younger members, and all public sector pension schemes were required to remedy the discrimination. So for the last couple of years, this has been a big challenge for the administration team and software providers as well across the whole country nationally. So what's been prioritised has been getting the software adjusted to be able to do calculations going forwards. And then we also have a remedy period for any calculations that we need to recalculate that have already happened in the past. So under two lots of legislation, the Public Service Pension Act and also Local Government Information Regulations, it is possible for administrators and the admin authority to make a determination to allow an extension. The original expectation was that all those recalculations historically would be done by August 25. That's not been achievable for numerous reasons. One of them being that the legislation and subsequent guidance that actually explains the intention of the calculations has been coming through later than intended, shall we say, which has then meant that the software has not been able to be updated in time. As I say, that this is a national problem, not just a Devon Pension Fund problem. So in order that we can do these recalculations and meet the requirements of the adjustments with McLeod and the remedy, what we've done is we've put a plan in place to prioritise those members that are due extra money. So people that are already receiving a pension or survivors of those scheme members. And we're working on those now. They're the ones that we've prioritised. We're hopeful that we'll be able to get those in place and calculated, or certainly the vast majority of them by August 25. And then any other calculations that we need to go back and remedy. So, for example, if somebody's transferred in pension benefits from a different scheme, we have to go back and review that if they're impacted. Or if someone's had a pension sharing order following a divorce, we also have to go back and revalue that calculation for both the member and their pension credit member beneficiary. So we haven't got all of the guidance yet for those cases, actually, the last ones that I mentioned. So the new date that we're proposing for the discretion that we are allowed to have under the legislation is August 26 is the final cut-off, that everything will be remedied that needs to be remedied by then. We've got 4,477 individual scheme members that potentially could be entitled to an addition. So basically we have to look at what the old scheme benefits were and what the new ones were, and they get the best of the two. So they get like an addition added to their pension if they qualify. And what we need to do now is really, in order to get all these reviewed properly and fully, the August date isn't going to be achievable, as I said at the start. So we will need to write and get a communication out to those that are not going to be recalculated by that date and tell them that it's been extended through to August 26, so that basically the annual benefit statements that go to active contributing members or deferred pension members, the annual ones that are sent next year, will reflect McLeod, but they won't reflect it this year. So we will need to put a caveat in there and a clear communication that that's the case. But those that are due monies, we are working on at the moment to get those extra monies out by August this year. So the conclusion of that, with the plan that we have in place, is that what we would like to do is to ask the committee to approve the deferral of the full McLeod rectification as we are able to, with the discretion under the regulations, to August 2026.
Okay, we've got a number of questions. Let's start with Roberto.
In view of the complexity of this operation, it's been going on for some time now, and the actual nitty-gritty of it, I think it's quite very important that they should be given the option to continue to conclude the work, because there are a lot of people waiting for the results. They may not be very significant, but in some cases will be helpful to have the additional money or the recalculations that are necessary. And as it's August 26, that at least gives us a final date by which it will be completed. So I suggest that we agree.
Mike?
Just again, can you just clarify that this August 26 date, you'll not be coming back to us in 6 months' time and saying, no, it needs to be December 20. You know, how certain can we be that this definitely will happen? There are no further problems, because I think the members in the scheme would like that reassurance, and I assume once this decision is made today, members in the scheme impacted by this will be informed of this change. So I'd hate us to, as I say, have to come back in 3 months or 6 months' time and say, sorry, software is not working properly or something.
Absolutely, yes. Key to the extension, part of the requirements under the legislation is that we communicate clearly with all members so they know. So absolutely, that's part of the plan. As far as calculations, there are, like I say, there's still some guidance pending from government on the pension sharing orders. So providing we have that guidance and legislation in place, then yes, we will get the calculations done by August 26. But obviously, if we have any little aspects like that missing, then we just can't do them because there's no formula to be able to recalculate. So yes.
Simon.
Thank you, Chair, and thank you, Rachel. I mean, I know it's interesting that this committee goes from, oh, the Japan market's looking good, right down to sort of someone got divorced and worked here for 4 weeks, or so it's great. But I this is really complicated stuff. So thank you for all your hard work on this. And as was just said, we're going right down to the wire with this one. What happens if we do slip over it? I mean, are the penalties if there are still some outstanding cases, etc., when we come to the 31st of August next year?
So the plan, what we're actually aiming for, needs to be sooner than August. So on the plan that I've given the team, we're aiming for March, April, because we need to have the data ready to go out on the statements before the 31st of August. So we have a bit of a cushion, if you like, before the statements are due out. If that wasn't achieved, if it was because we were waiting legislation, that's fine. We can quote that when the pension regulator asks us. But if it's for us because it's not had enough resource put to it, or we've not achieved it, we would need to record that as a breach to the pension regulator. That's how that would work. That is not my intention, just to say.
Thank you. Yes, you've made that clear. I mean, excuse me if this is a cheeky question, but have we had previous deadlines that we have missed? I mean, obviously, you expressed it was an aspiration to get everything done by 2025, yeah. August 25.
No, that's the first deadline we've had for McLeod is August 25, and that's what all administrators across the country were working to. It's in practice just not been achievable.
Jeff. Thank you very much, and thank you very much for the work that you and your team have actually been doing. I mean, you've had you've had a delay of 12 months with the new modules. You're still waiting for guidance, and you've had legislation amendments. So it is hard work. However, what I would ask is your timeline. Each time we have a meeting, could we have an update, please?
Definitely, yes.
Any further questions? Okay, do we have someone to move that we? Okay. I'm just going to spit it out. Okay. All in favour? Okay, that's approved. Thank you. Moving on to item 14, Peninsula Pensions Administration update and performance statistics for us to note. Rachel.
Okay, so yes, you will see that my hot topic is administration as opposed to investments. You'll quickly see all my papers relate to administration, pension calculations, and payment of such. So every quarter, I'll give a little bit more background this time with obviously some new members. So every quarter we provide a performance report across all of the schemes that we administer. So this is referring just to the Devon Pension Fund, but we also provide administration for the Somerset Pension Fund, the Gloucestershire Firefighters, and Avon and Somerset Police, just for information. So this report specifically relates to the Devon Pension Fund. So we have to record our performance against the Occupational and Personal Pension Scheme Disclosure of Information Regulations 2013, that's a big one. Which basically set out the statutory requirements for different elements of calculations that we perform. So our performance is measured against that, and we've got some charts on this report, which I'll refer to in a minute. So for the quarter ending the 31st of March 2025, our performance against the statutory requirements was that 97% of high priority procedures and 95% overall were in target. Now, with our high priority procedures, if you would like to refer to page 126, where you'll get a breakdown of all the different types of work that we undertake on the team and the different disclosure categories that we have to measure against. So the top little chart you'll see is showing the high priority, medium priority, and underneath that you'll see what's included in each of the categories. So for example, with the high priority, the key ones there are payroll, making payments of pensions or changes to pensions in payment, retirements from active membership, someone's been contributing and retires, or someone that's deferred and brings their deferred pension into payment on retirement, and the complaints, any complaints we've had are in there as well. Medium priority are estimates, so we encourage scheme members to obtain their own estimates online now as much as possible. So we have our online portal which will provide that information for the majority of members. There are cases that won't work for, and we highlight that on the portal. So for example, I'm going to mention pension sharing order cases again because they're a bit more complicated. They're not actually reflected online, so we do those in-house. And deferred benefit records, we put those as medium priority because they're not due a payment immediately. They're due money is in future, so they go in the medium category. You could argue them all as high priority really, but obviously we need to prioritise when we're working through it all. And then low priority cases we have in there, so pension transfers in and transfers out. So when individuals bring pension benefits into the scheme or transfer them out elsewhere, or from other local government authorities. So there's inter-fund transfers in there. That's what that refers to if they've moved from, say, Somerset to Devon or vice versa, or countrywide, that's called an inter-fund. So they are the priority cases. So the team have they've done, I think, exceptionally well in the last quarter. That's actually higher than the previous quarter as well. So like I said, we've had 95% overall in target against those disclosure regulations. and 97% for those high priority, because we always make sure that they're pushed to the top. So we've had 6 compliments recorded for the team between January and March. Hard for the team sometimes to show me their compliments, but they're the ones that have come forward and are recorded. We have other charts at the back. So if I refer to pages 128, that's actually showing you. So at the end of Q4, which obviously we came to at the end of March, I then do once a year performance across the whole year. So page 128 shows performance of the team across that whole financial year. So it's showing that 92% across the whole year were in target against the statutory requirements, and 96% of the high priority were in target. You might also notice on the under high priority, and it would have been on the same previous chart, to the right hand side it says about performance internal targets. It's got PAS internal target. That relates to the pension administration strategy, which is a document that's in place. It's an agreement between ourselves and employers of what the expectations of them are, and our expectations of when we'll get work actioned as well. So it's measured against them as an internal, and it only shows some of them with targets because they're the ones that have been agreed with employers in that agreement. So not all of them. And then you've got lots of charts all the way through to the end, which basically show how we've performed over different years. So at the top of page 130, it shows high, medium and low priorities back from September 22 to where we are now. So you see March 25 actually looks really neat and tidy, and they're all being sort of actioned around the same point. Page 131, it will show you how much work we've actually received over different months. On average, it's about around 7,000 pieces of work come in, around approximately. There's 6,000 here for March 25. You'll see that outstanding remaining is 5,968 pieces of work. So that means that there's 4,391 that's with the team to actually action, and there's 1,577 that are with waiting for further information. So either from a member, because we've asked them for a choice, they've had to make their option, or send in birth certificates, etc., or from employer where we've needed more data from them, or the original data, so we know a person's left and we're waiting for them to give us that ILEVA information. If I just go back to a couple of the other points that are in here, and then I can take questions if anyone wants any more detail. So I mentioned in there under 3.7 on page 124 about McLeod. I've already said that we've got about 4,477 individual scheme members that we've identified, where we've got to review calculations. So sometimes that'll mean more than one calculation we have to review on them. So if they have had a transfer in and then they've left, we'll be looking at 2 different calculations for reviewing. So they're quite time consuming, shall we say, for McLeod. We've also got the National Pension Dashboard coming in to play. So it's not actually going to be live in October 25, but the deadline that we have to be able to connect the data that we're responsible for to that national dashboard is the 31st of October 25, so that we can then ensure that when it does go live in a future month nationally, that our data is moving backwards and forwards as it's required to. We've done stage 1 of testing was last year, end of last year, which was successful. Stage 2 is still happening now. So it started in May, as it says in the report, and it's been still going backwards and forwards with our software providers at the moment. Part of the work that we're doing for the pension dashboard is to get our data as clean as possible. So if there's any members that have got deferred benefits, they're the key ones that quite often don't necessarily remember to tell us when they've changed address, for example. So we have to do like a data cleanse and try and see if we can trace them using a tracing agency. So it's work like that we're trying to get in place before the dashboard goes live, as well as an ongoing. At the bottom of page 124, we've got employer performance reports. So this is separate to the audit assurance that was referred to earlier. What we provide is employer performance reports quarterly, so that they can see, and you as a committee can see, and the board can see how well individual employers are doing on various aspects, and we're building on those reports as we go forward. And Devon Assurance have been helping us with the database for that. We've got in the report here that there were 4 employers that had outstanding member data that had been notified they were due to receive a fine under the pension admin strategy. So that admin strategy was reviewed last April 24, I should say, and in there was included some fines and charges. And this is the first time that we've started to push for the data, because all the data that we asked for was pre-April 24 data that was still outstanding this year from employers. So there's been plenty of time for employers to provide it to us. What I'm really pleased to say that the employers had a letter advising them what the fine would be, and that they needed to provide the data by the 31st of May. And all of those employers achieved that. So there were no fines this time. We're now moving on to sending out the same letter to all employers if there are outstanding queries between April 24 and March 25, and then we'll do it rolling. And I think that pretty much gives an overview of that report. So I don't know if anybody's got any questions at all.
Simon.
Oh,
Sorry, Chair.
I thought I'd
heard
everyone in silence.
I mean, earlier on, this came up earlier on as well, that and everybody went, well, of course we don't want to name the employers. I mean, if people are even in the short term failing to getting to the point where we're threatening them with fines, don't their pensioners have the right to know that?
So the individuals that are impacted will know that we're waiting for data, and they'll know it's from their own employer. So those individuals were. I've not named them in the report because I wasn't sure whether that would be the committee's preference or not. So for me, they've not been included.
I think if we get to the point where we actually do levy a fine, then we'll probably name them in the report, because that might be an additional incentive. I mean, I think the positive that we took out of this was we wrote to people saying, we're going to fine you and this is what we're going to fine you. And then they all delivered. So in a way, that was a better result than fining them, that we actually got what we needed from them.
And the reason the fines brought into place is that other administrators has found them successfully working. And it was a lot of the team's time being taken, keep chasing this information, and their time should be doing calculations, not chasing information from employers. So hence the charges are reflecting the time it would have taken spent on that chasing.
Yes, Mike.
And can you give us any indication what the scale of fine would be and what happens to that money?
Yeah, so on the, do you have an electronic copy of the report as well? Just checking, I'm not sure, because there is a link on there which will take you to the breakdown of all the fines if you do have. Okay.
No, we've got a printed bundle. We have had it. Yes.
The link.
Okay.
In terms of what, I mean, if effectively all of this costs us additional work if employers are late, if we have to keep chasing it up. So there's a time commitment, it's a resource that we have to put in to sort it out. So effectively what we're doing is we're recharging the cost of actually having to chase it and follow it up and all the extra work that creates that we're charging. So it's just coming into the fund to effectively fund the work that we have to do to deal with the issue if they haven't responded on time.
Thanks for that clarification. I was just wondering whether it went on to the regulator, whether we were
No.
actually fining on behalf of another body, therefore it was a cost.
Further questions? Yes, that's noted. Thank you. Moving on to item 15, I'm aware that we're running significantly over time, but Brunel are aware of this as well.
Normally at the conclusion of the meeting, we then have a session with Brunel where we hold them to account for their investment performance, but I'm going to suggest that we don't do that now because we are so late and they probably have other commitments anyway. Normally they come down to the meeting, but we were aware that the agenda might take a long time, so we said that they could join us online. But I think if you're happy, we'll release them for today, but we'll make sure that we allocate time to that at our next meeting, because that is an important part of what the committee needs to do.
It is, or alternatively, we could potentially arrange a Teams meeting, which might be more convenient for everybody, and won't be in September, will be soon. That depends on schedules in June and July, really. Any of you just put it out to the committee?
Consideration is whether is their advice taken in public. So therefore, all I was thinking is whether access to Teams, but if it's a private briefing effectively from members of the committee, chair's suggestion would be highly suitable.
Effectively, that's what it is anyway, because we've closed the formal meeting and that's the private meeting that follows, but we could try and do that as a separate session on this occasion.
Where are we? Item 15, LGPS access and fairness consultation. For us to note that the consultation is underway. Rachel.
Okay, so I'm not going to say too much on this, so don't worry. This consultation basically covers a variety of tidying up of the administration legislation, should we say, with a couple of additions. So there's an element which will cause a bit more work for us, which is survivor benefits and death grants. So they're equalising survivor benefits, which has been pending for some time because it's been corrected in some of the other public sector pension schemes. There's some additional reporting that they are proposing we do on gender pensions gap benefits and also on people opting out of the scheme and reasons why they might do that. There's some tidying up around forfeiture of pension because it's quite a difficult element to actually use at the minute. So they're making it more able to be able to enforce under certain circumstances. McLeod remedy, as I mentioned earlier, there's some aspects there. There's 5 different aspects that they need to clarify for us. So hence, again, another reason why the discretion was required. Abolition of LTA. So LTA is lifetime allowance and HMRC charge. That has been removed as far as pension calculations are concerned, but there's a new measure in place. So tax is still there and it's been replaced with a lump sum allowance instead. And then there's some tiny changes, other changes where they're just tidying up around some ABC options and payments of refunds, etc. So the key one really, I mean, we're supporting pretty much all of these, and I will be doing a response. So the deadline is 7th of August. We'll be doing a response. So we do welcome the changes, and some of them have been pending for quite some time. And yeah, the one that's going to take us a bit more time on the team, which we have a project team allocated, and so they will take this on, is the survivors benefits and recalculations of those historical cases. So that's just really to note that this is underway.
Any questions for Rachel? Yes,
Chair, this represents an improvement to the conditions in general and equalises the different discrimination that has existed in the past in some areas. So I welcome it and I'd like to formally move it.
Yes, we're here to note it. So any further questions? so that's noted. Thank you.
Thank you.
Moving to item 16, the annual training plan 2025-26. For the committee to adopt this. Charlotte.
Thank you, Chair. The fund is required to produce a training plan and monitoring report on training activity undertaken throughout the year. Section 3 of the report summarises the training sessions that were held during the 24-25 year. Appendix 1 is the training plan for 25 and 26. The plan outlines the training, the fund and the fund's approach to training of new committee members and board members, planned training sessions to be held throughout the year, and training requirements for officers. Since the time of drafting the plan, the government has finally responded to the good government recommendations as part of the Fit for Future consultation. As expected, the government is going to extend the knowledge and skill requirements that currently apply to pension board members to the committee members. I would also like just to draw members' attention to the next training session, which is in the afternoon of July the 16th. The board meets in person in the morning, and we hold a joint training session with the committee and the board in the afternoon. Thank you.
Can I ask, is that going to be accessible by Teams, or is that an in-person event?
It is an in-person event, but we will, I think it's going to be in here, so we will have the same setup as we do for the committee. Which I'll need to
the committee itself, I've already set up a training, a remote link for the committee, for the board meeting itself. So I can send the training.
Works better if you're here in person.
Yeah, the training, are you going to set that link up, or? Yeah,
set it up.
That will come from Mark then.
Okay, Roberto.
I wish to commend the committee to the particular process. In the past, it has been essential to make sure two things. That the first one is that members are aware of what the processes are. And the second one is to demonstrate to people outside, including government, that we are operating on a professional level. I think it becomes much more important for members to understand that the training that the board members have had will be the same as what we will be having in the past. I, for instance, have done all the training, but I have welcomed it because it opens your minds as to what we're doing and why. So I recommend it.
Thank you. Any further questions? Okay, Roberto, are you happy to move this? Second, please. Yeah, Henry. All in favour? Yep, that's the lot of us. Thank you very much. Item 17, employer changes. As noted here on the agenda, I have one point here on the last point under Part B that Marwood have joined Venturous. Venturous is no longer called Venturous. I don't know what it is called, but they've merged with another mat. Okay, thank you. Any questions on item 17? Item 18, date of future meetings. Again, they're scheduled there. The next one being 19th of September. Don't think there's anything else to add. We're all itching to get away. Thank you very much. There are new councillors here, and I think that's partly why got inquiring minds in the room, which is partly why this has gone on so long. Thank you for attending, and the meeting is closed.